Hello and welcome to this episode of In Focus, where we discuss the issue which is influencing market sentiment for better or worse. I'm Santosh Nair and with me is Udayan Mukherjee, Consulting Editor, CNBC TV 18, and we'll be discussing market trends and investing strategy in the backdrop of renewed tensions between India and Pakistan. Morning Udayan, good to have you with us.
Morning Santosh, hi.
So the market has been quite volatile over the past couple of weeks, reacting to developments at the border. So how should an investor assess the situation right now?
You know, Santosh, I think it's important to distinguish between what category of investor you are when you ask this question, because I think the answer is quite different from an investor to a trader. For an investor, the Indo-Pak tensions and escalations actually present quite a bit of worry because you don't want the situation to escalate beyond a point. And therefore, for a long-term investor, while it's very important not to panic, because there has been a lot of loose talk about us getting into a war-like situation, it's very unlikely, nothing is impossible in the world, but very unlikely that something as precipitate as that will happen. And therefore, I think the first thing to do for an investor is not to panic and sell off stocks. Having said that, I think it would be very prudent to be defensive in one's portfolio right now if for a long-term investor, because you don't know where this escalation might lead us. On the other hand, for a trader, as you've seen over the last few days, last 10 or 12 days since the escalations broke out, there might be bouts of volatility which present trading opportunities. Equally, there might actually be the possibility of a rally because the Indo-Pak escalation in the tension actually is leading the market to infer what the political outcome in the current elections would be. And I think a lot of the market's reaction is basically based on that kind of a political assessment of what happens to Narendra Modi's chances after the Indo-Pak tension. And therefore, the chances of a near-term rally have also increased, pre-election rally have also increased, particularly in mid-caps and small caps. And therefore, traders would do well to try and capitalize on such a rally and focus on mid-caps and small caps. So the answers to the two are different. Investors should not panic and they should be defensive in their portfolio. Traders should be looking at it with a sense of opportunity in mid-caps and small caps.
So do you see this tension having a bearing on the outcome of the elections, which in turn could then influence expected returns?
That is the billion-dollar question. In fact, that is the reason why the markets have started rallying in the last few days. Because the market's perception, for right or wrong, we'll know whether it's right or wrong only when the election results are out, is that all this escalation of tension between India and Pakistan will actually get people behind the leader of the nation, Narendra Modi, and therefore his chances have increased with the breakout of tensions between India and Pakistan. Now, this may seem ironical that the market is actually betting on a positive electoral outcome during a tension between two neighboring nations, but that is how the cookie crumbles in India. And people genuinely feel now that with the tensions, the current dispensation, the current government has got a greater chance of controlling the narrative and uniting people behind itself, and therefore raising its chances in the current elections in April and May. And that is the perception which is driving the current mood in the market. Now, we have to be careful because history tells us that we cannot jump to conclusions. There have been enough instances in the past where even after armed conflict and more serious conflict than where we are sitting now, the current government has actually lost an election. It has happened with Atal Bihari Vajpayee, and there are more instances of that in the past. So this is the current perception, but history is a slightly volatile guide to this perception that it follows that the current government will benefit from tensions between the neighboring countries. So while one might choose to play this rally, I think it pays to keep history in mind and not jump to conclusions or firm conclusions at this point in time.
So we saw the market recover after some initial weakness, but what if hostilities were to rise once again? How should investors then look at the situation?
I think if hostilities were to begin again and to rise, then we might get into a scary kind of situation, because some traders might believe that with rising hostility, the government's chances are increasing. But with rising hostilities comes the real possibility of us getting stretched into a long conflict or even war-like situation. And that is something which the economy cannot afford. This will certainly lead to a fairly significant exodus of money from foreign investors and will dampen sentiment for domestic investors into mutual funds. So escalation is not a desirable, and if escalation were to happen over the next few weeks, I would say that people should start pruning their exposure. Long-term investors should start pruning their exposure to equities, get more capital allocation into fixed deposits or safe instruments, maybe fixed income kind of instruments. Maybe not discontinue their SIPs yet, but certainly pare down exposure to direct equity if escalations were mount from here. So while the current mood can be capitalized on for a trading rally, the picture changes dramatically if escalations were to skyrocket from here, because at that point equity investors will have to reassess the situation and become far more defensive with their capital allocation.
Thank you, Udayan, for joining us and sharing those insights with our viewers.
Thank you.